Hello, this is Joe Pryor with virtualrealestateteam.com in Oklahoma City, a part of Redbud Realty and Associates. This is part 5 on investing in real estate in Oklahoma City. Now, in the last video, we talked about taxes. We talked about, first of all, how to avoid them paying taxes on rental property. This is where you have a depreciation schedule on the improvement of the property, since land never depreciates. And I showed how if you had $250 positive cash flow, and $257 a month in what you can take in depreciation, that you could pretty well offset yourself there and not have to pay taxes on that income. Now, what I want to talk about today is that second part, which is selling the property. Now, in the example in part 4, we talked about the two types of taxes that you have to pay. That you have to pay back 25% of what you depreciated in the property. And then second of all, you have to pay capital gains, whatever that is at the time, which is 15% right now. And of course, that's always subject to change. And what we're going to talk about today is how to avoid paying those two taxes and selling the property. Now, this is where instead of selling and cashing out, and there's no way to avoid taxes on that, is where you sell and you want to buy more investment property, and this is called a 1031 Tax Deferred Exchange. And we're going to get into the basics on that. Now, essentially, it is this. You put your house for sale, you get a contract on it, there is an agreement that the buyer and seller agree to that everyone knows it's a 1031 Tax Deferred Exchange. There's going to be a third party that handles the money in this, and there's going to be a brief moment in the transfer of title where they don't own the property, the people that are the buyers as well as you. And so that's not a big deal, but it has to be disclosed. It also has to be disclosed for the IRS. Then what happens is you don't touch that money. So let's take that $100,000, for instance, we talked about in buying an investment property. Let's say you held it long enough for the property to appreciate. You just saw some other good opportunities and you want to sell it, and you have $70,000 in proceeds. Now that $70,000 is going to be held. You're not going to touch it. Now, what the IRS wants you to do at this point, if you want that tax deferment, this is not tax elimination or tax relief, it's tax deferment. It allows you to identify the properties within 45 days. Remember, I said properties. We can buy 2, maybe 3 properties with this $70,000. So say, for instance, we saw 2 properties that we could buy at $100,000 a piece, and that they would cash flow at least $300 a month. And the reason why is maybe rents have gone up a little bit, but also that $70,000 that you have has to be spent completely. So for the sake of simplicity, we're going to say $35,000 a piece. You're going to have $650, $65,000, excuse me, in terms of what your mortgage amounts is. In fact, you may even have more than $300 a month positive cash flow. So in other words, you've been able to sell out of one property because it was a good deal, find 2 other good deals, spend at least what you sold the property for. So say you sold it for $150,000, you're buying 2 $100,000 properties, that's $200,000. That meets the criteria, and you put contracts in on them within the 45-day period the IRS wants. Then the IRS says, okay, that's fine, but now you got to close within 6 months. They give you a long time to close on it. You have 45 days to identify and do a contract on these properties, but you have 6 months to close. So what's going to happen is that that company that's been holding on to your money is going to apportion that $35,000 a piece. You're going to close on those 2 properties, and now you have 2 rental properties that's making you a lot more money. Now, here's, I think, the really cool thing about a 1031 exchange. And this is another way of looking at what the government is doing for you. Let's talk about that $70,000 you didn't have to pay taxes on. That's in terms of buying these 2 properties. That's like the government giving you a $70,000 loan interest-free. Think about somebody saying, look, Joe, I'll give you $70,000 to buy these properties. You're not going to pay any interest on it. That's essentially what they're doing. You're putting that towards the other. Now, there's no limit on what you can do. In other words, you want to do this every 2 years, every 4 years, whatever. You don't run out of opportunities to do 1031 exchanges. In fact, one suggestion I'm going to make for you is if you treat rental property as income, using the depreciation to offset the taxes, you should do this until you get to the ultimate tax break, which is death. Now, I know that's not a pleasant thing to think about, but essentially, here's what happens. You've 1031, every properties that you had, you've expanded your portfolio, you're getting tremendous cash flow, and then it transfers to your kids. They get a wonderful inheritance, and guess what? Even those properties have been depreciating. For your kids, the government lets the depreciation start all over again. And they learn a lot about the wealth that you can build in investing in real estate. So that's a 1031 tax deferred exchange. It's a way of increasing your portfolio and deferring your taxes, well, for the rest of your life. This is Joe Pryor with virtualrealestateteam.com in Oklahoma City, where we deliver traditional real estate values at the speed of technology.